Welcome to the 47th installment in Trading Strategy Guide's Trading Education Series. Today we're going to look at the trend following trading strategy. Wait right there. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. Today we're going to look at the trend following trading strategy. So the trend following strategy uses the Ichimoku indicator. Coincidentally, I looked at a very similar Ichimoku strategy in a video a few weeks ago. As it turns out, this is the place for another Ichimoku strategy in this series, so we'll take a look at it again. But first, let me tell you guys about my Comcash Alerts app. It's an app for your phone or desktop that will allow you access to my trade setups and give you the venue to ask questions that I can answer directly. I'll also be sharing additional trade setups on the platform too. Look for the link below. In this video, I'm going to teach you how to use the Ichimoku indicator to follow trends. The Ichimoku indicator gauges support and resistance, then helps determine the future price movement. If you've never looked at the Ichimoku, you might find it intimidating. Just the name is intimidating, right? Once you understand it, you'll find that it is pretty simple, actually. With a little practice and patience, you won't have any trouble with it. Now, before we get started with the trading strategy, let's look at the indicator. There are 5 lines, and they're all different colors to make them easy to identify. I'll give you the Japanese names so you'll at least hear them, then I'll give you the English equivalent. Please forgive my pronunciations. The first line is the Tenkan Sen line, also called the conversion line. That represents the average midpoint of the last 9 candlesticks. Next, the Kijun Sen line, also called the baseline, and that represents the midpoint of the last 26 candlesticks. The Chiyu span, also called the lagging span, lags behind the price, hence the name. The lagging span is plotted 26 periods back. Next is the Senkou span A, also called the leading span A. This represents one of the 2 cloud boundaries, and it's the midpoint between the conversion line and the baseline. This value is plotted 26 periods into the future, and it's the faster cloud boundary. Next is the Senkou span B, or the leading span B, and that represents the second cloud boundary, and it's the midpoint of the last 52 price bars. This value is plotted 52 periods into the future, and it's the slower cloud boundary. Lastly, the Kumo area is the area in between the 2 points of the Senkou span. This can be defined as the space between the Senkou span A and B. The cloud edges identify current and potential future support and resistance points. The Kumo area, or simply the cloud, will be either red or green, sometimes orange and green, depending on the current market trend. Remember, these images that you've been looking at contain my personal settings for this indicator. If you don't like the colors, they can be changed. But for this strategy, we'll use the actual TradingView default settings. This strategy should be used on higher time frames like the 30-minute, 1 hour, 4 hour, 1 day, or even a month. The reason? Well, this particular indicator follows trends, so a lower time frame, such as a 1-minute time frame, will possibly give you a false reading. So let's have a look at the strategy. Step 1. Use the Ichimoku indicator to find the uptrend or downtrend. Since this is a trend following strategy, the first thing that needs to be identified is a trend. Do this on the 1-day or 4-hour time frames. These time frames will give you the best opportunity to identify a trend. In this example, we see a trend line with an upward trend with at least 3 levels of support. Drawing trend lines is one of the simplest ways to find a trend. Draw the trend line where there is support or resistance. This example has 3 different levels of support to confirm this uptrend. By definition, this trading strategy will always go in the direction of the trend. So an uptrend will always be a buy, and a downtrend will always be a sell. Step 2, the conversion line, or Tenkan Sen, and the baseline, or Kijun Sen, will cross each other. Just so you remember, the conversion line is red, and the baseline is blue. This crossing signal is going to tell you whether there is a strong bullish trend or a bearish trend. When the red conversion line crosses above the blue baseline, that's an indication of a bullish trend. You can see in the example the lines clearly cross, which is our indication that this bullish uptrend is strong. After the cross, the blue line is below the red line. That means the trend will most likely continue upward. This was used on a 4-hour chart, which is the best time frame to use because it gives you a good overall picture of how the last few days have been trending. In this time frame, the lines need to cross either in the Kumo area or in the cloud, which is the orange area in this case, or right above the cloud. This was a buy signal because the trend was bullish, while the red conversion line crossed above the blue baseline in the cloud area. Understand that if the lines cross below the cloud area in an uptrend, you don't want to buy. The opposite can also be applied to a downtrend. If the lines cross above the cloud area in a downtrend, do not sell. That would be considered a weak trend signal. You can see these lines crossed within the cloud, so it meets the buy signal criteria. If the lines crossed below that Kumo area, this would be no trade. Remember, your job is to identify the trend and trade in that direction. Step 3, determine your entry point. Determining an entry point should be pretty easy to do now. This is because once the red conversion line crossed over the blue baseline either in the cloud or just above it on the 4-hour time frame. Now simply drop down to a 1-hour time frame chart and enter the trade. You may want to check other time frames, but there really is no need since you have already followed the rules to enter the trade on the 4-hour time frame. This is just to give you a better perspective on where you are entering. Step 4, place your stop loss below 4-hour support. Please always set your stop loss. I know some traders like to use mental stops, and that's okay, but if you're a new trader, I recommend that you place actual hard stops in the market. But you can migrate to mental stops in the future if that makes you happy. I've been trading a long time and mental stops do not make me happy, so I don't do that. You guys have heard me say this before. You do you. Anyway, do this on the 4-hour time frame chart to see when the last areas of support or resistance were. There need to be 2 or more points of resistance or support. In this example, you see that there were support levels. So the stop loss will go just below those support points. And step 5, take profit when the conversion and baselines cross again on the hourly chart. Our exit strategy is to hold the trade until the trend starts moving in the wrong direction and the lines cross again. I recommend watching this on the 1-hour time frame to get an earlier exit signal. That typically signals the end of the trend. As you can see in the example, the trend was slowly going back down. In the rules of this strategy, you will exit the trade if the lines cross over again. So you may end up in a trade for 2 hours, 10 hours, 3 days, a week, or even longer. Just stick to the rules and watch the chart. The trend following trading strategy only uses the Ichimoku indicator. It may seem complicated at first with all the different colored lines and clouds and so on, but when you break it down with this simple strategy, it makes it so much easier to understand. Remember, don't risk more than 2% of your account on any one trade. No matter how confident you are, do not exceed that. And please never go all in. Remember, trading is about catching the statistical advantage in the market, and no trading strategy is ever 100% effective. Always practice a strategy so you have the confidence to stick with it. And that's it for today's video. Next week, we're going to look at some actual examples of trades that I've made and see a few notes about them. And hey, you've heard about the Comcash alerts, right? Yeah, I've got my own app now. You can get my trade setups and my trade tracking and even chat with me if you want. You know, I do a weekly trade setup video. Well, those trade setups will be available on the app, plus the other trades I personally take every week. In fact, I posted 5 additional setups last week to the app. Plus, we can chat about trades or the weather. You know, I talk a lot about the Texas weather, right? I'm good with that. I'll be happy to answer your questions right on the chat page of the app. The Comcash Alerts app is available for iPhone, Android, and desktop browser. Click the link in the description below for more information. And come back Friday for my strategy of the week and next Monday for my trade picks. My videos come out at 3 p.m. New York time on those days. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. And if this video helped you, smash that like below. Subscribe and hit the bell if you want to be notified of our videos in the future. Have a great Wednesday, and I will see you Friday.